1930 to 1935, 750,000 American farms seized through foreclosure and tax sales, not confiscated by soldiers, not stolen by foreign invaders, transferred through property tax delinquency, while farmers still owned productive land. Marshall County, Minnesota, 191 foreclosures. Kittson County, 127. Pennington County, 123. The arithmetic that killed them: corn prices collapsed from $1.30 per bushel in 1919 to 28 cents by 1932, a 78% decline, while property taxes per acre tripled from 46 cents in 1913 to $1.45 in 1930. Farmers produced 80 acres of corn at 40 bushels per acre. 3,200 bushels times 28 cents equals $896 gross revenue. Property taxes, $120. The mortgage payment taken out when corn was $1.30, $240 annually. Total obligations, $360. Net farm income after costs, $300. You cannot service debt when your revenue collapses 70%, but your fixed obligations triple. Between 1930 and 1935, 60 of every 1,000 farmers either lost their farms or filed bankruptcy. The largest forced transfer of agricultural assets in American history, caused not by crop failure but by a property tax system disconnected from agricultural income. And the mechanism that seized those 750,000 farms, still embedded in every state tax code today, unchanged, waiting for the next commodity price collapse to activate. The land seizure threat isn't martial law confiscation or eminent domain during national emergency. It's the 1,800 days of property tax bills you'll owe between now and collapse. Preppers harden perimeters, stack ammunition, install solar arrays and drill wells. Then the county assessor mails an $8,000 annual property tax bill. Miss 2 years of payment? Tax lien auction. Miss 3? Your $500,000 survival retreat transfers to an investor who paid $15,000 in back taxes, plus 20% annual interest to foreclose your equity. You can have 5 years of freeze-dried food, defensive positions, livestock, heirloom seeds, and medical supplies. If you can't pay 60 months of property taxes from liquid reserves, the county auctions your homestead on the courthouse steps to the highest bidder. No soldiers required, no constitutional crisis, just contractual obligations enforced through normal legal proceedings. The Great Depression proved governments don't suspend property tax collection during economic crisis, they accelerate it to maintain revenue. 750,000 farmers learned that productive land and survival skills don't prevent seizure when you can't generate cash to cover fixed governmental obligations. 10 factors determine whether you keep your land or lose it to tax sale. The 1920s agricultural depression established the vulnerability before the 1929 stock market crash. Farmers borrowed heavily during World War I, when government price supports and export demand made expansion profitable. Then Europe's agricultural production recovered. The Fordney-Macumber Tariff of 1922 and Hawley-Smoot Tariff of 1930 triggered retaliatory trade barriers that collapsed US agricultural exports. Corn fell from $1.30 per bushel in 1919 to 47 cents by 1920, 63% decline in 1 year. By 1932, 28 cents per bushel. Wheat dropped from $1.65 to 44 cents, 73% collapse. Hog prices fell 75% to $3.20 per £100. Farm income declined 70% nationally, while property taxes increased. Minnesota property taxes rose from 46 cents per acre in 1913 to $1.45 in 1930, tripling while the income generated by that land collapsed. The tax system provided no relief mechanism proportional to earning capacity. Farmers faced a choice: abandon production to avoid losses while still owing fixed charges, or produce at surplus that further depressed prices. Neither option was economically viable. National forced sale data: 26.1 farms per thousand lost in 1930 to 31, up from 20.8 per thousand the prior year. Between 1930 and 1935, approximately 750,000 farms transferred through foreclosure, tax sale, and bankruptcy proceedings. The pattern: property tax obligations remain fixed regardless of income collapse. Governments prioritize revenue collection over agricultural continuity. The law provides no suspension mechanism during economic crisis. This isn't historical anomaly, this is documented government behavior during the last systemic breakdown. The legal mechanism that sees 750,000 Depression-era farms remains essentially unchanged in 2025. Property taxes become delinquent when unpaid by the due date, typically December 31st or the following April. After delinquency, the county accumulates penalties and interest, typically 1.5% monthly, 18% annually, or higher. After 6 months to 3 years, depending on state law, the county either sells a tax lien certificate to investors or auctions the property itself. Georgia. The sheriff conducts tax sales on the first Tuesday of each month. Properties sell starting at taxes due plus interest, penalties, and costs. The high bidder receives either a tax lien certificate or immediate deed. Maryland. Tax sale purchaser receives a certificate of sale. The homeowner retains redemption rights, typically 6 to 9 months, to reclaim property by paying taxes, interest, penalties, and the purchaser's acquisition costs. If not redeemed, the purchaser forecloses and takes title. California. 5-year redemption period, but the mechanism is identical: accumulation of penalties, eventual sale, transfer of title if not redeemed. The interest rates make this extraordinarily profitable for investors. Maryland. 20% annual interest if the owner redeems. Some states allow 24% or higher. If the property isn't redeemed, the investor receives the entire property for the amount of back taxes paid, often 2 to 5% of market value. Tyler versus Hennepin County, 2023. Hennepin County took possession of a homeowner's property for $15,300 in unpaid taxes, sold it for $40,000, and kept the $25,000 surplus. The Supreme Court ruled unanimously this violated the Fifth Amendment takings clause, but only because the government kept the surplus. The actual seizure mechanism for tax delinquency? Perfectly constitutional. Chief Justice Roberts. A taxpayer is entitled to the surplus in excess of the debt owed. But the government can absolutely seize your $400,000 homestead for $15,000 in back taxes, sell it, and transfer title as long as they return the surplus. The Tyler decision provides property owners better recovery of equity after seizure. It doesn't prevent seizure when you can't pay property taxes. You don't lose property because the government declares martial law. You lose it because you missed 36 months of tax bills and an investor paid $24,000 to acquire your $350,000 survival retreat through the county's foreclosure auction. Let me show you what happens when governments decide property rights are negotiable. February 2000, Zimbabwean voters reject a constitutional referendum authorizing compulsory land acquisition without compensation. Democratic process says no. President Mugabe's response: implement the rejected provisions anyway through constitutional amendments. Constitutional Amendment 16. A. Shifted compensation obligation from the Zimbabwean government to the former colonial power Britain. Practically eliminated ability to pay compensation by designating a foreign government as responsible party. Constitutional Amendment 16B. Eliminated notice requirements for land acquisition and prevented landowners from challenging government decisions in independent courts. The Fast Track Land Reform Program, 2001. Seizure of approximately 4,500 commercial farms comprising 7.6 million hectares, 20% of Zimbabwe's total land area, accompanied by systematic violence. War veterans and ZANU-PF militia forcibly occupied farms, at least 7 white farm owners murdered. The allocation revealed the lie. Cabinet ministers received 160 farms. Sitting ZANU-PF parliamentarians received 150 farms. Only 2 farms allocated to the 2,500 war veterans allegedly driving the occupations. Land distributed to political elites rather than landless peasants. Agricultural consequences. Maize production declined 31% in the 2000s, relative to the 1990s. Food insecurity. Grain imports. By 2013, land occupation remained concentrated in government allocations rather than achieving egalitarian redistribution. The mechanism: government passed constitutional amendments eliminating compensation, preventing court challenges, and authorizing seizure. Courts initially struck down seizures as illegal. Government ignored court orders and amended the Constitution to prevent future challenges. Trust structures, irrelevant. Beneficial ownership arrangements, ignored. Legal title, void by constitutional amendment. When governments refuse to recognize property rights or constrain executive power through courts, no legal structure offers protection. The transition from compensated acquisition to non-compensated seizure requires only legislative will and suppression of judicial review. This happened in a country with functional courts, recorded property titles, and constitutional government until the government decided those constraints no longer applied. Fifth Amendment Takings Clause. The government may not take private property for public use without just compensation. Two conditions. Taking must be for public use, and owner must receive just compensation. Kelo v. City of New London, 2005. The city used eminent domain to seize private homes for transfer to a private development company to generate tax revenue and employment. The Supreme Court held this constitutes public use, even though property transferred to a private corporation rather than government. Economic development qualifies as public use. Tax revenue generation qualifies. Job creation qualifies. The public use requirement provides almost no meaningful constraint. Just compensation, fair market value. But during crisis, market values collapse, making compensation minimal. Now add emergency powers. The Brennan Center identified 137 statutory powers available to the President upon declaration of national emergency, plus 13 additional powers when Congress declares emergency. These authorities include powers to requisition property, commandeer transportation and communication facilities, and alter commercial relationships. During COVID-19, governments quarantined property, restricted use, imposed operational limitations. Courts generally held these didn't constitute compensable takings because owners retained some use. But when California destroyed chicken flocks suspected of carrying Newcastle disease, courts required compensation because the owner's property was destroyed rather than regulated. The application to agricultural property during crisis. A government characterizing food security as a national emergency could invoke substantial authorities before courts intervene. The bar for public use is extremely low. The compensation requirement means paying market value, but during crisis, collapsed market values make compensation minimal. Victory gardens during World War II. The federal government coordinated 20 million gardens producing 40% of the nation's fresh vegetables through patriotic appeals and community organization. No taxation of produce, no requisition of harvests, participants kept their production. But that was voluntary cooperation during a popular war with high legitimacy. The legal framework for mandatory requisition existed, the government chose not to invoke it. Current law allows extensive government seizure authority justified by broad interpretations of public use. The constraint isn't legal, it's political will and judicial oversight. If those fail, the legal framework provides minimal protection. Let me address the claims circulating in prepper forums. The government taxed victory garden production during World War II, and they requisitioned your harvest for military use. The documented evidence, neither happened. The Victory Garden campaign mobilized 20+ million gardens between 1942 and 1945. Production reached approximately 40% of the nation's fresh vegetables by 1943. But the mechanism was voluntary coordination through patriotic appeals, not taxation or requisition. Contemporary accounts describe participants retaining ownership of harvests. USDA publications encourage preservation and canning for household consumption. By 1944, more than half of Americans who planted gardens reported economic necessity. They needed the produce to supplement restricted food supplies, not patriotic impulse. The government focused on maintaining agricultural production through price supports and commodity programs, not on taxing household gardens or requisitioning private harvests. The claim assumes governments will immediately move to total control and extraction. The reality, governments during World War II, maximum governmental authority, total war mobilization, price controls, rationing, industrial commandeering, still didn't tax household garden production or requisition private harvests. The actual threat isn't that the government will show up to take your tomatoes. The threat is that you won't be able to pay property taxes on the land where you're growing them, and an investor will buy the tax lien for the back amount owed and foreclose. Different mechanism, different defense required. If you're realizing the actual threat to your survival homestead isn't confiscation but tax delinquency, and that your defensive preparations have focused on the wrong seizure mechanism, hit that subscribe button. This is the Independent Financial Historian. I analyze property law, tax foreclosure procedures, and historical seizure patterns using publicly available sources, court records, USDA reports, state tax codes, Supreme Court decisions. This video is for educational and entertainment purposes only. I am not a financial advisor. Want sources for any claim, exact case citation, state tax codes, historical documentation? Ask in the comments, I'll send you the links. The mechanism that actually protects property. Liquid financial reserves sufficient to cover extended property tax obligations regardless of income. The Great Depression vulnerability. Farmers operated with minimal cash reserves because capital was invested in land, equipment and operating inputs. The expectation was that annual production would generate income to cover expenses. When commodity prices collapsed, current production couldn't cover current obligations. The modern difference: you can accumulate reserves designated specifically for property tax obligations before crisis hits. The arithmetic: property worth $500,000 typically generates tax obligations of $5,000 to $15,000 annually, depending on state and local rates. 5 years of property taxes, $25,000 to $75,000, 5 to 15% of property value. 10 years, $50,000 to $150,000, 10 to 30% of property value. Substantial but feasible for established operations with positive cash flow. The strategic logic: property tax obligation is the most reliable seizure mechanism available to governments. It doesn't suspend during economic downturns, it accelerates as governments desperate for revenue increase assessments and eliminate exemptions. Implementation: separate account. Treasury bills or money market funds, maximum liquidity, minimal risk. Denominated in the same currency as your tax obligation. Calculated based on current assessment plus 20% buffer for reassessment increases. Recalculate annually. If your property tax bill is $12,000 this year, assume $14,400 next year to account for rate increases during fiscal stress. 5 years, $72,000. 10 years, $144,000. The hard question: what if you can't accumulate that reserve while also preparing the property? Well, livestock, solar, food storage, defensive positions. Then you're making a bet that crisis arrives before your tax reserve runs out. You're betting systemic breakdown happens in year 3 rather than year 8. You're betting property tax collection mechanisms fail before your redemption period expires. That might be a reasonable bet depending on your timeline assessment, but recognize it as a bet rather than a defensive position. The documented pattern from the Depression: governments maintained tax collection through the entire crisis. They auctioned 750,000 farms. They didn't suspend property taxes until recovery began. Your property won't receive special treatment because you're growing food. The defensive strategy isn't complex. Liquid reserves sufficient to pay property taxes for extended periods regardless of income. Let me show you why trust structures marketed for asset protection provide minimal defense against property tax seizure. Land trusts hold legal title, while beneficiaries retain the right to occupy, use, and profit from property while remaining off public records. The trust's name appears on title rather than the beneficial owner's name. Advantages: privacy, liability separation between properties, simplified beneficial interest transfers without deed recording. The limitation for property tax defense: if government is determined to identify property ownership, trust structures provide only minimal concealment. Government agencies compel disclosure of beneficial interest through normal discovery procedures. The beneficial interest remains subject to creditor claims if courts treat the trust as a fraudulent conveyance. Asset protection trusts, more specialized structures allowing grantors to transfer property while retaining beneficial interest and discretionary distribution rights, protect against normal creditor collection and civil litigation. But efficacy depends entirely on judicial system integrity and rule of law maintenance. The Zimbabwe lesson: courts initially struck down land seizures as illegal. Government ignored court orders and passed constitutional amendments preventing future court challenges. Trust structures became irrelevant. Beneficial ownership arrangements ignored. Legal title voided by legislative action. When governments refuse to recognize property rights or constrain executive power through courts, trust structures offer zero protection. The trust protects against normal creditor collection, civil lawsuit judgments, privacy from casual observers, probate complications. The trust does not protect against property tax foreclosure by the county. The trust must pay taxes or face seizure. Eminent domain: government can take trust property the same as individual property. Emergency powers seizure: Government authority operates regardless of ownership structure. Constitutional amendments eliminating property rights, as Zimbabwe demonstrated. The practical recommendation: trusts serve useful purposes for estate planning, privacy, and liability separation. They don't substitute for having liquid reserves to pay property taxes. They don't prevent government from seizing property through legal mechanisms when governmental legitimacy breaks down. Focus on the actual threat. Can you pay property taxes for 60 months during economic collapse when you have no income? The ownership structure doesn't change that question. December 2023. UK government announced it would increase the threshold for agricultural and business property reliefs from £1 million to £2.5 million per individual, £5 million for couples, before paying inheritance tax. Takes effect April 6, 2026. This represents the second major concession since original budget 2024 proposals. The evolution reveals governmental recognition that excessive taxation of intergenerational property transfers forces asset sales incompatible with maintaining agricultural operations. Agricultural property relief reduces taxable value of qualifying farm assets. Prior threshold, £1 million per individual. Assets exceeding threshold received 50% relief, meaning they remained subject to 20% inheritance tax above the threshold. For a farming family with £3 million in agricultural land and equipment, original £1 million threshold generated approximately £600,000 tax liability. New £2.5 million threshold generates approximately £400,000 tax liability. Still substantial forced liquidation pressure. The difference determines whether families can maintain operational continuity or must sell portions of the farm to meet tax obligations. The policy demonstrates governments can recognise when property taxation becomes destructive to agricultural continuity. The UK chose to increase thresholds to protect small to mid-sized family farms. But, and this is critical, the threshold still exists. Larger operations face inheritance tax obligations. The policy protects some farms while accepting others will face forced sales. The pattern: governments balance tax revenue collection against preservation of agricultural productive capacity. During normal times, they sometimes choose to protect agricultural continuity. During crisis, as the Great Depression demonstrated, they prioritise revenue collection. The UK made this choice during relative stability. The Depression-era United States made the opposite choice during crisis. Which pattern applies during the next systemic breakdown depends on governmental legitimacy, fiscal desperation, and political will. Don't assume your government will choose agricultural continuity over revenue extraction when fiscal crisis hits. The historical record suggests otherwise. Let me address the prepper concern about adverse possession, squatters' rights, and whether occupation during systemic breakdown could transfer title. California Adverse Possession Statute. 5 consecutive years of occupation, cultivation or improvement of land, payment of all property taxes throughout the occupation period. Occupation must be hostile, actual, open and notorious, exclusive, and continuous. The burden of proof falls entirely on the adverse possession claimant. Successful claims require formal litigation to quiet title in court, attorney representation, and judicial determination. Other states impose higher barriers. Unregistered land sometimes permits adverse possession after 12 years. Registered land requires 10 to 12 years, plus proof the adverse possessor reasonably believed they owned the property. The critical requirement: payment of property taxes throughout the entire occupation period. Adverse possession requires the squatter to do exactly what protects against all property seizure: pay property taxes continuously for years. An adverse possessor who fails to pay property taxes faces the same tax sale auction as any other owner. During systemic breakdown scenarios where government institutions cease functioning, if courts stop operating, no mechanism exists to adjudicate adverse possession claims. The statutory requirements remain high barriers but become unenforceable. Title law degrades, but possession simply becomes whoever can physically control the property, not legal adverse possession, but effective occupation through force. If government maintains enough function to collect property taxes but courts become unreliable, the adverse possessor must still pay taxes or face tax sale auction. The county assessor doesn't care who pays the bill as long as someone does. The practical reality: adverse possession protects against absent owners during normal legal system function. It doesn't protect against tax foreclosure. It doesn't provide mechanism for seizing property during systemic breakdown unless the original owner has abandoned the property and the squatter maintains occupation plus tax payments for years. Your survival homestead faces orders of magnitude greater risk from missing property tax payments than from squatters filing adverse possession claims. The operational security concept applied to property, making productive agricultural land appear fallow or poor quality to avoid attracting attention from assessors or looters. The theory: maintain productive gardens and livestock operations in ways that aren't visible from roads or aerial observation. Avoid improvements that increase assessed value. Make the property look economically marginal to discourage both tax assessment increases and targeting during crisis. The agricultural implementation: locate gardens behind tree lines or in areas not visible from public roads. Use hoop houses or low-profile growing structures rather than obvious greenhouses. Avoid building structures that require permits and trigger reassessment. Maintain portions of property in apparent fallow or wild state, while concentrating production in concealed areas. Minimize external indicators of prosperity, new vehicles, equipment, obvious improvements. The assessment risk: property assessors determine value based on highest and best use, comparable sales, and visible improvements. A property that appears underdeveloped may receive lower assessment than one with obvious high-value improvements. The Great Depression precedent: some farmers allowed portions of property to appear fallow to reduce target profile for seizure. Assessors dealing with thousands of properties used visible indicators rather than detailed investigation of productive capacity. The limitations: most jurisdictions assess based on land classification and comparable sales rather than individual property inspection. Your grey man strategy might reduce attention from neighbours, but won't necessarily reduce assessed value if the assessor uses county-wide land value maps. This strategy assumes assessors and government agents will make superficial observations, determined investigation, satellite imagery, drone surveillance, informant tips, defeats visual concealment. The strategy potentially reduces productive capacity by requiring concealment rather than optimal growing conditions. The trade-off between security and production efficiency must be calculated. During severe crisis, when desperate people search for food sources, any productive agricultural operation attracts attention regardless of concealment attempts. The smell of livestock, presence of water sources, evidence of habitation all create signature. The realistic assessment: grey man property strategies provide marginal benefits for reducing assessed value, increases in casual observation threats. They don't substitute for having liquid reserves to pay property taxes. They provide limited protection against determined government investigation or systematic searches during crisis. The primary value: reducing attractiveness as a target during early phases of crisis before systemic breakdown reaches the point where visual concealment becomes irrelevant. So what do you actually do? First, liquid tax reserves, non-negotiable foundation. Calculate annual property tax obligation. Multiply by minimum 5 years, preferably 10. Separate account. Treasury bills or money market funds. Maximum liquidity. Recalculate annually as rates increase. This is the single most important defensive measure. Everything else is secondary. Second, minimize assessment increases. Avoid improvements requiring permits that trigger reassessment. Understand your jurisdiction's assessment methodology. Challenge assessments through formal appeal processes when justified. Don't advertise property improvements that increase assessed value. Third, political engagement in tax policy. Property tax systems respond to political pressure. Depression-era states passed foreclosure moratoria because organised farmers demanded action. UK increased inheritance tax thresholds because agricultural constituents applied pressure. Local tax policy, assessment practices, redemption periods, exemptions is determined by county commissioners and state legislatures subject to political accountability. Organised property owners can influence these mechanisms. The hard truth: you cannot defend property from government seizure through force. The county doesn't send armed agents to collect property taxes, they send auction notices. You can't shoot the legal process. You cannot hide property ownership sufficiently to avoid taxation. Property records are public. Assessment is systematic. Trust structures provide minimal protection. You cannot rely on courts to protect property rights. If governmental legitimacy collapses, Zimbabwe demonstrated constitutional amendments can void property rights faster than courts can defend them. The only reliable defence: liquid reserves sufficient to maintain property tax payments regardless of income. Everything else is marginal improvement or theatre. If you can't accumulate adequate tax reserves while also preparing the property, you're making a timeline bet. Be explicit about that calculation. The question isn't whether you have 5 years of freeze-dried food. The question is whether you have 5 years of property tax payments in liquid accounts when agricultural income collapses and you can't convert production to cash. If this analysis showed you the primary threat to your survival homestead isn't confiscation but tax delinquency, and that defensive preparations need to prioritise liquid reserves over ammunition stockpiles, hit subscribe. This video was inspired by your comments asking how to protect rural property during economic collapse. Everything here comes from publicly available sources: Supreme Court decisions, state tax codes, Depression-era USDA reports, property law case studies. Want exact citations, case names, statute numbers, historical documentation? Drop a comment. I read every single one and I'll provide the specific legal reference. Here's the binary choice. The question isn't whether the government will send troops to confiscate your homestead during martial law. The question is whether you can pay 36 consecutive months of property tax bills during economic collapse when you have no income, and your property's productive output can't be converted to cash fast enough to meet the county's payment deadline. 750,000 farmers during the Great Depression learned this distinction. They had productive land, food security, equipment, and community support. They lost their property to tax auctions because they couldn't convert corn worth 10 cents per bushel into cash, sufficient to pay property tax bills that didn't decline when agricultural prices collapsed. The seizure mechanism was legal. The process was orderly. Property transferred to new owners through county courthouse auctions. No martial law required, no armed confiscation, just contractual obligations enforced through normal legal procedures. The pattern is documented. The mechanism is unchanged. The vulnerability exists right now on the property you're preparing as your survival retreat. The defensive strategy isn't complex. Liquid reserves sufficient to pay property taxes for extended periods regardless of income. The discipline required to accumulate those reserves while also funding property improvements, that's the actual test. Your move.